Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing. And we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
Welcome, everybody, to this week's episode of the Tech Guys Who Invest podcast, where each week we teach you how to invest wisely and safely. Our next guest, David Van Horn, serves as president and CEO of the PPR Note Company. His chief responsibilities include the oversight of the company's strategic planning, business development, and fundraising functions. Mr. Van Horn's expertise is derived from over 30 years of residential and commercial real estate experience as a licensed Pennsylvania realtor, investor, title company partner, and commercial fundraiser. In addition to his role as president and CEO, Dave's biggest passion is teaching others how to build and preserve wealth. Dave is a co-founder and board member of Strategic Investor Alliance, a purposeful planning and networking group for accredited investors in the Philadelphia area. Dave is also a national speaker, author, and investment blogger on biggerpockets.com. With his passion for teaching others how to invest, you listeners are going to get tremendous value from this week's episode. So enough from me, and without further ado, here is the episode with David Van Horn.
At the time of this recording, we've been podcasting for a little over a year. This is our 59th episode. We absolutely love doing it and couldn't be more grateful for our listeners and supporters. As educators, we have a passion for sharing the knowledge we accumulate, the lessons we acquire from taking action, and the investment tips and strategies from the awesome guests we've had the pleasure of interviewing. We've dedicated each week to teaching you how to invest wisely and safely. We want to thank all of you who listen to our show. As a token of our appreciation, we're working on a gift for you and your friends. It's going to contain 5 tips from various professional investors, previous guests of ours, that will help you maximize your profits while reducing your risk. We will be releasing our first ebook on Friday, February 28th, 2020. Keep an eye out for it on social media and on our website, tgwipodcast.com.
Welcome, everybody, to another episode of the Tech Guys Who Invest podcast. On this episode, we have Dave Van Horn. He's the president CEO, PPR Notes. He's active on Bigger Pockets. He's written a book on note investing. And Dave Van Horn's podcast episode on note investing was actually the reason and inspiration as to why I got into it. Fun fact.
Welcome, Dave.
Impressive.
That's awesome.
I don't know how I got into it on Bigger Pockets. I was probably the only guy writing about notes. That's probably what happened. So
First of the market.
Yeah, I do a few other things, but yes, they singled me out.
Cool. Well, we're excited to have you on the show, Dave. So why don't we kick it off with having you explain to our listeners some of the advantages of note investing relative to other real estate investing, like, for example, investing in real property?
Well, I mean, the first one that comes to mind is that it's really passive, right? And although the IRS says real estate investing is passive, I think when my property manager is calling me with bed bugs, I don't feel that it's that passive.
Right.
But notes are truly passive, especially performing notes where they're with a servicer. You're pretty much just collecting payments. I think there's a volume and control advantage where you can scale. So banks figured that out a long time ago. I'm sure, Bank of America would rather have, 30 million mortgages instead of 30 million properties.
Right.
They're also profitable in various market conditions, and they're also a collateral-backed investment. So any time, that's kind of what attracted me to it. I've traded options and done different things, but the one thing that I liked about it is anytime I could buy something at a discount with a high yield with collateral, that was the game-changing thing for me. They're also versatile, almost like anything you can do with a house, you can do with a note. So you can flip a note, you can rehab a note, you can sell a piece of a note, you can borrow against a note. So a lot of things that you can do with property, you can do with notes. And they're also, an asset-backed investment. There's actually there's one extra step, but there's a piece of real estate behind it. So they're in direct correlation to real estate values. But and the last one probably is the social conscious investing kind of component where it's sort of like a community stabilization thing when you're doing modifications to keep people in their homes. You're doing everything you can to do that, or you're taking a vacant property and getting it back into the tax rolls and back into society and the community. Nobody wants a boarded up house with 2 feet of grass on their block, right? So
yeah. So that social component, and that's what drew me towards it. We were talking about you can make a return, but you're helping people. And what are the ways, or I guess what is one of your favorite stories of helping somebody stay in their home as a note investor?
Wow. We don't. There are times when, I'm not an asset manager today. My one partner oversees all that, but there are cases where, like a bank would typically foreclose, and there are cases where if everybody's doing everything they can, but it still doesn't make sense. There's cases where we leave them in there anyway, that kind of thing. Whereas, a typical bank might go ahead with foreclosure in some of those cases. So, we do all kinds of things to forgive that. Bad things happen to good people. The 4 main reasons people default are death, divorce, job loss, and medical. So, bad things can happen to good folks.
Right.
That's really what it is. So there's, we have thousands of loans. So it's hard to, it's like somebody says, who has a good deal this week? Well, it's like, how do you raise your hand to that? Because, we're selling hundreds of houses a year, and, it's hard to couch that a little bit, or it's more about a trade to us. How well was that trade?
Yeah.
So, Dave, you mentioned a lot of advantages in there I thought were really attractive. One of them you mentioned was you were just sort of talking about how it's very similar to real property in terms of the advantages and what you can do. And I just had a question about the tax side of things, and without getting super technical or detailed or anything. Yeah.
And we know you're not a CPA also.
Yeah, I'm not a CPA. I'm not a lawyer. And nor do I want to be. No.
Are there tax advantages associated with notes like there would be with, say, owning a rental house?
Well, the answer is it depends, right?
Okay.
Really, there's no depreciation, right? That's the big one. But you can do, you can own a note in your self-directed IRA or a qualified plan. So, and usually it's interest income, right? So you can, or it's a short-term or long-term capital gain if you were to sell that note. You held it a while. Did you hold it a year and a day? That kind of thing, just like property.
Right.
Okay.
But you don't have depreciation in the sense of, it wears out. But, and when it comes to appreciation, it doesn't have it in the true sense of the word. Like, you bought a house for $100,000 and then someday, 20 years later, it's worth $200,000 or whatever that is. With a note, you do have phantom appreciation is what we call it. And that means, I might have bought a loan at a discount and now it's reperforming for a long period of time. So it's seasoned and all of a sudden it becomes worth par again. Or it could be a case where, I bought an asset that was partially covered with equity. And then now equity came back in the marketplace. So now the asset went up in value and I really didn't do anything. Now it'll never go higher than, what the loan amount was plus any arrearage or, back payments or something like that. But you bought it at a discount. So there's some neat things. There's some neat characteristics. Loans a lot of times are front end loaded with mortgage interest, or the modifications front end loaded with interest. A typical loan in the U.S. only lasts about 5 to 7 years. And if you look at an amortization schedule, all your interest is in the beginning, right? So,
right.
So there's some plays there in the sense that, I can own a loan or a new modification and collect payments for a couple of years and then turn around and sell the asset for the same thing I could sell today for, right? Which is kind of a unique, spin on things. So there are some, I don't want to say strategies, but there are characteristics of ideal times to buy and sell. And then, of course, there's different asset classes. So there's strategies in all the different asset classes of, we deal with primarily first and second mortgages nationwide, 1 to 4 family residential type assets. So,
Okay.
But there's other asset classes, and then there's multiple strategies within those classes,
Yeah, that's a very good point. So when you talk about first and second, what would be the advantages of a first position versus that of a second?
Well, a first position asset, usually you can deploy more capital.
Mm-hmm.
Today, you're in an up real estate market, so margins are a little tighter. but you can deploy more money, and there's equity in the market today, right? So it's very, I don't want to say predictable. And you can do very well with that. And with not junior liens,
Yep.
you can position yourself into a deal with a small amount of money, and it's I guess you're taking on more risk, but there's more upside. So it's really about learning how to manage the risk, and the better you are at that, we were fortunate. We kind of came up through the junior lien space and then went into the first mortgage space. So many folks do it the opposite way. We weren't that smart. We did the other way, and it had more to do with who was showing us the business when we were starting out, that type of thing. So we didn't know any better, basically.
Dave, a lot of our listeners they're pretty well paid employees, and they invest probably a very large percentage of them invest in mutual funds and things like that, because that's just what they've been taught.
Index funds, right?
Yes.
Yeah. And why might it be interesting for them to consider investing in notes? What might you tell someone who isn't very familiar with it?
Well, it is real estate, so that has a real estate backed asset in that regard. Well, it depends whether you're investing in the actual notes themselves or you're investing in a note fund. So they're different investments. The note fund, you're well diversified. You have limited liability. You are investing in the management team. It's similar to investing in shares of a non-publicly traded stock. When I think about, if I compare a note fund to stocks and bonds, it's probably similar to a bond fund because it's debt, right? Like It's kind of similar that way. I guess, that people might be able to get their mind around, a pool of mortgages being similar to bonds.
Right.
So that's probably, and it's, it is a different market cycle. Like the real estate market moves a little slower than the stock market, that type of thing. So there's some advantages there. I don't think it's it can get overvalued. Don't get me wrong, but it's a different cycle, right? And then the the actual notes themselves. Well, then it's similar to investing in real estate. If you have one note and it redefaults, you have a 100% default rate. If I have 10 notes and one redefaults, I have a 10% default rate. So you kind of see where that's going. But I think when you own the note, you own the asset. So it's, you're on the hook for that. Now there's advantages. You also can step in and do stuff too, right? You're not, so, and you could end up with a property occasionally, right? So you're just not going to have them all the time,
Right. Now, as far as the market, you're saying that you're seeing tons of notes come in. That's your business model. How are you seeing the market change? I guess what is your sense on the note market today?
When we started, it was an up market. Then we went through obviously a down market, and equity left a lot of our portfolio. And at first we were kind of panicking because we had all equity assets, and then all of a sudden we didn't have as much equity, right?
Right.
Equity doesn't dictate outcome, and that was the big lesson for us. So when you work through the assets, what we found out was we were overpaying for equity, and we found out we made a lot of our money on partial equity and even no equity assets that we paid very little for. So you could buy a partial equity asset for maybe a third of what an equity asset would cost, but yet you would exit, almost just as many. So you might get out of 7 or 8 out of 10 instead of 9 out of 10, but you paid a third of what you normally would pay, right? So it's all relative, and that was the big aha after the downturn. And then you're back up. Most markets are back to where they were before the crash. So it's like high tide raises all ships. So a lot of times you'll hear people complaining about the current up market or something. But what side am I complaining about? Am I complaining that my portfolio just went through the roof and that we're getting great execution on what we sell? Or am I complaining about, margins are a little tighter on what you're buying, So it's, I think the folks that are complaining the most are probably people trying to get into the space where they're trying to time the market. Kind of.
Right.
Dave, for those who may not understand what a partial equity asset is or a full equity, could you help them with that a little bit?
Yeah, sure. If you had a first mortgage of 100,000, the property's worth 120,000. That's a normal type of mortgage, or
Right.
125 maybe.
Okay, yeah.
The a partial equity would be, it's $100,000 property. I mean, $100,000 first mortgage, and the property's worth 80,000. That's a partial equity deal.
Okay.
And if you had a junior lien, back after the crash, we saw some pretty crazy things where you would see, the house was worth 100,000, it had a first mortgage of 125 and a second mortgage of 50, right?
Jeez.
Yeah.
And you might buy that asset for a pretty good number. And, a lot of it would, believe it or not, with junior liens, it depends more about the senior lien status and occupancy. Like, are they current on their first mortgage? Because those assets, perform differently than other ones, so that a lot of times, senior lien status is actually more important than equity when you're buying junior liens, which is a concept for real estate investors, right?
Interesting.
That's hard to get their mind around, right?
Yeah. Well, thank you for breaking that down. Now, in terms of when you were doing the actual, note investing, I know that you said you're a little bit far removed for that. What were the common mistakes that either you made or you saw newer investors make?
You mean as an asset manager, or
yeah, or as a note investor, asset manager, however you want to call it?
Well, asset managers don't make too many mistakes because they're working somebody else's assets. The biggest mistakes I made as a note investor, you got to know your note seller. I've had challenges there before. Just as well as you have to know the asset behind the note.
Right.
You have to know the documents and the note. So it's really education in the space, a little bit of experience. In the beginning, if you don't have any experience, it's you could be learning how to play the guitar. I'm going to tell you the same thing. Practice, go get educated, hang out with other people that play guitar. Get a coach or a mentor to teach you the guitar. It's kind of the same thing in any of these in real estate and notes is to shadow someone else's deal, partner with somebody who has more experience, whatever that is, to get the you don't have to necessarily put all your money at risk or anything.
Right.
And kind of learn what you're doing, learn the ropes. And there's other ways to start out slow. Like you could start out with performing notes or in a note fund. You don't have to, once you venture into non-performing, that's where a lot of your liability and compliance and your real experience needs to come into play. And then what type of assets are you investing in? Like if you're investing in commercial notes, there's a lot less liability than owner-occupied residential loans, for example. They're heavily regulated, right? So
as they should be.
So there's different ways to venture into the business, and then also invest in what you know. Like I have a heating and air conditioning guy. Years ago, I was out to lunch with him, and I said, "Hey, did you ever think of financing the heating and air conditioning units?" And he goes, "Oh, there's a company that does that." I said, "Yeah, I know. You can own that company." And he's like, "Oh," and I go, "Well, that is the note business, right? You could take a deposit on an air conditioning unit or a heating unit, and you can create a note. And then now, if they don't pay you can put a mechanics lien on their house, and you can get a service contract out of that and increase the value of your business. So you can get into the note business by investing in what you know. I have a dentist buddy in Dallas, Texas, did the same thing. He started financing dental work. And then years later, the dental finance business actually became more valuable than his dental practice. So you never know. You never know that nobody says you have to do notes exactly the way I'm doing it. You have all kinds of debt out there. You have student loan debt, medical debt, auto debt, just credit card debt. It just goes on and on and on, right? So
how did that dentist secure the loan?
Well, he didn't. You'd have to go.
Okay. I'm going to take that crown back.
It's really very similar to credit card debt. A lot of people say that to me about well, how do companies function without collateral? And it's because it's credit based. And what you don't realize is people go, well, that's risky. There's no collateral. Well, every bank almost in the United States does credit card debt, right? So they know the default rates. It's that simple, and they know it's tied to credit. So they factor that into their cost of doing business. So I think people, get a little weirded out or overthink it, but there's plenty of unsecured debt out there in the world,
Yeah, that's pretty interesting. And I think that's part of the reason for the higher interest rates is because there's more risk in that.
Right.
Yeah, that's really interesting. And I don't think a lot of people think about notes as what you just described. So it's really cool to hear you sort of talk through that a little bit.
I always tell everybody, you're all in the note business. You just may not know it, right? I'm not saying everybody, but if you think about it, how many people have credit card debt, auto debt, medical debt, mortgage on their house, student loan debt? It's a lot of people, right?
Yeah.
We can say pretty safely that most people have one of those or have had that. Well, they're in the note business. They're just on the other side of it, right? They're not used to receiving a check or being the bank or buying it at discount.
Yeah. When you first got started in the note business, do you recall if you had some mental barriers you had to break through? Was there, anything that you really felt like was scary to you and you pushed through it to get where you are now?
I started out in the seller finance side where I would try to get owner financing on a house I was buying in real estate. And I was an agent, a property manager, and owned a title company, all those things, right? Being a contractor too. So I did a lot of different things, but it was kind of what I started to notice was, I would hold a second mortgage when I sold a property to another buddy who was a real estate investor too, that kind of thing at first. And then I was doing the private and hard money thing. I'd lend fellow contractors deals, money on their deals, either from lines of credit I had or from my qualified plans. And what started to happen, I was a property manager at a Remax at the time. And I was like, okay, I'm managing these properties over here, over 100, hundreds of something units. And over here I have mortgages. And I'm like, over here, I'm an inspector. I'm in court every week. Over here, I'm like, I don't have any of that or very little, it's like, it just became very apparent to me. It was like, whoa, this is a no-brainer. What am I thinking? And I was absolutely on my path to have 100 properties and even ventured into commercial real estate, had done a lot of, I've been syndicating over 20 years. And, I still do some investing myself. I'm in apartments and multifamily and all kinds of stuff, to be honest with you.
Excellent.
But I just, it was a niche that I liked. And I believe it or not, as crazy as it sounds, some people say to me that you're in all these different things. And really, I'm not. Everything I do is real estate, lending, or insurance related. And I've had licenses in all those. I've had activities in all those and businesses in all those. So it's not as bizarre. I usually don't deviate, from those things. Like if somebody came to me and said, I don't know, do you want to invest in a nightclub or a restaurant? Or I'd be like, no, I've done that stuff before and lost money. But I'm like, no, because these 3 or 4 things that I do regularly, I feel good about, and I know the space, and I just kind of stay in my lane a little bit, even though it looks like I'm all over the place, but I'm really not.
Yeah, invest in what you know. I mean, you don't go to those nightclubs very often, Dave. I mean,
oh, you go there. That's an investment too, but that's a bad investment as well.
Fantastic. Well, thank you for sharing that mental barriers. You took a step back and said, all right, this is the route that I want to go because I'm not dealing with the headaches. Now it's just different headaches, more debt-related headaches, huh?
Now I just meditate a lot. Well, I have 30, 25, 30 employees typically at any given time. So they're different kind of headaches. But.
Now, when you talk about it, you invest in other things and investors can get into the note space and most people are part of the note business. How could you recommend an investor who, let's say, only invest in single family or only invest in multifamily? How could they get started in becoming a note investor?
I was that same guy. I was the guy that said, I'm going to buy one house a year, and then I became the guy, I'm going to have 20 free and clear. I was that guy. And then I'm going to have 100 houses. Then I'm going to have apartments, multi-unit. I was that same guy. And then I went into mobile home parks and storage centers and new construction, commercial office condos, and you name it. I've done all these things. But it kind of, I was doing it simultaneously with the note space, because people would lend me money to do my rehabs, or I'd lend, you hit a roadblock with the traditional banks sometimes.
Right.
And, when I really think about it, I rarely go to a bank. Today, I'm like my own bank. We raise significant capital. We deploy significant capital, all without banks. I mean, PPR is pretty significant now. What we raise, it wouldn't be unheard for us to raise 150 million this year. So it's really grown to where, and it's all private capital, private equity. So There's it's a unique opportunity out there. I think the internet created that ability.
Sure.
Before the internet, I don't know how I would have even done this business this efficiently. You know what I mean? It would have been today. I can send someone out to a property almost anywhere in the U.S. for about $40, right? Well, I can't drive down the street for $40 myself, right? So it's become that kind of a world where you're able to scale things and do things that you weren't able to do. I can get photos and data that I could never get, almost instantly, right? So it's just a much different world today that enables you to do that. And a lot of it is technology. I mean, to be honest with you.
Yeah, that's excellent. So you're the CEO of a company with multiple employees working for you. How, what kind of say habits or routines do you have that you think helped you kind of grow into that type of leader?
I got it by default. My other partner said no. No, I'm like kidding. No, I don't know. It's a good question. Well, probably because I'm on the capital raising side.
Sure.
I'm on the syndication side, and that kind of is where it's the chicken or the egg. What's to start with, and it's really the capital that starts the movement, right? And then I pull capital together. My partner John goes out and does acquisitions and oversees a lot of that, buying and selling, and then my other partner Bob, oversees all the asset management activities, surveillance activities, all that type of stuff. All the REO, we have REO as well. So, it's kind of, I don't know, it just fell on me at that point. But you are right. I do have a routine. I get up early. I read a lot. I meditate. I exercise. I do all the same, that you might hear on a Tim Ferriss podcast. But I'm sure most folks that are fairly successful are doing some type of routine,
right?
So that they get more done, basically.
Yeah,
it's really what's the one thing that's going to move the needle. I say
right.
that I've had some really good coaches, some high level coaches over the years, and a lot of it is what's that one thing that's going to dramatically move the needle in the next 6 or 12 months in your personal or business life. And really honing in on that prioritization, almost like a Gary Keller.
Right, exactly. That's what I'm thinking when you said that.
Yeah,
it makes everything else, useless or unnecessary or whatever. There's a lot of truth to that. We get caught up in the minutia of where we treat everything equally important, and it's really not. And it's really, and then getting your teams to do that and your folks to do that. We follow Scaling Up, which is similar to EOS type system. So we have, an operating system that the staff works on. So it's really trying to get everybody on the same page and moving in the right direction and focusing on the right stuff and trying to get, as much, we're pretty lean and nimble. And I think there's advantages. There's disadvantages too, but
of course,
outsource a lot of things too. You're kind of, it's funny what you outsource and what you insource and how it evolves over time,
Yeah.
So, we're in our 13th year. So,
okay.
Pretty stable at this stage,
Sure. As far as raising capital goes, you've been doing it, you said syndicating over 20 years now. What would be some tips you have for people who are newer that are looking to raise capital?
Be honest, tell the truth. It's funny you say that. I mean, I walked through a process several years back where we looked at, where did every customer come from kind of, and we worked backwards, and we said, at one point, how I call it a visible edge, so to speak, where your customers hit your website or your telephone or whatever that is. And, how many people are bouncing off, how many people are, coming into the shop and going, I don't want to say through a funnel, but it kind of is. And, we might've had a dozen doorways and we were pretty much working them all the same, right? Well, we're going here and we're flying there and we're talking there and we're writing this and we're speaking there. You're doing all these things. And what we discovered was about 3 out of the 12 were where it was like the 80-20 rule is where everybody was coming. And we're like, well, why don't we focus 80% of our business on the 20% or the 80% where everybody's coming from? So that's an aha moment, right? But a lot of it is making, having your ideal client knowing who they are. We had like 3 levels of client. We had 3 levels of what we did was we adapted 3 levels of service for 3 levels of clients.
Nice.
And we wanted to give good service to the appropriate service to the actual different levels. And we got a dramatic lift from doing that whole type of process. And, I think the customers appreciate it. And we were spending the right time in the right places after that. And I think that had a lot to do with it. But you got to have your ideal clients feel comfortable and confident with you. I think a lot of it's transparency, those types of things. And then I also do some things for the ideal clients that I like to think are unique. Like I run a group called Strategic Investor Alliance, which is for high net worth folks only. And we have special events for them. And then we record things, and we do a lot of activities basically to create almost like I don't want to say a customer for life approach, but it's kind of like that where,
Right.
How would I want to be treated? We do believe in customer service. We don't want to be, lending club or, where you can only get in touch with somebody if you chat to them or something. And hey, is there anything worse than a chat where you have to get off the chat and call anyway?
Oh my goodness.
Isn't that enough?
It's so frustrating.
Like a needle in your eye or something. That defeats the whole purpose. But I just spent an hour on chat and now I have to call in the morning. We want to have that personal touch. I think everything from a new investor, we'll send a gift. We do different things, and we like to. Sometimes it's the little things. If you do a lot of little things right, it adds up to be big deal. Maybe now we're not perfect either, so I do like to let my staff have some leeway. I just had one the other day where the guy was struggling to get through the system. And I was like, well, can he go there on his own? And he's like, yeah, but it's a $60 charge. I said, pay it for him. Just pay. And that's what my staff member goes, it's okay to just pay it, right? I go, absolutely. We're not going to, get a client upset over a $60 fee. Like, just do it. Get it in.
Right.
It's like a Zappo thing,
Yeah. Just do what's right for the customer.
And give your staff the permission to. My theory is, hey, if you're falling within the core values and you thought you were doing the right thing, that I can't get mad at you for that. That's silly, right?
Yeah. So, Dave, what is something that you would tell maybe a young person or maybe even your younger self to help get them moving in the right direction in terms of investing, building their financial intelligence, becoming a strong leader like you are one day?
Well, they're different things, right? One's taking action, right? So that's, of course. I think people are afraid of, they're afraid of risk sometimes. And I'm not suggesting people should go out and do, dangerous things or risky things, but I think I'm more afraid of regret than failure.
Wow.
Right. So I don't want to be the guy that's 85 sitting on my front porch going, I wish I had done this and I wish I had done that. I would have rather gone out and done it and fallen completely on my face. And, I've lost, money on deals before. And I'm looking to run a multi-billion-dollar fund, right? We're going to hit $1 billion in probably less than 2 years under management, right?
Wow.
And I don't think you can get to $1 billion operation without losing money along the way. I was telling somebody that the other day, probably the biggest hit I've taken on his deal is probably $250,000. And people will go, well, that's a lot of money. How did you lose that? But I don't know that you could become a billionaire and have not lost $250,000 or whatever. I'm not saying you want to do that or try to do that. Right? Take it the wrong way. I hope you're not thinking I better get off this call. This guy's a loser. My point is, no one's trying to lose money at all, but you have to be somewhat of a risk taker. Not everything's going to work out. Hopefully, more things work out than don't work out.
Of course.
But I think it's the education you learn from some of these hiccups, so to speak. Was it a market thing? Was it a bad partner? Was it this? Was it that? And all those things get you to where you end up at, the overnight success when you finally do have $1 billion under management or whatever that is, whatever success means to someone. Not that numbers necessarily mean success,
Right.
Yeah.
Well, when you have those losses, how do you get past it? What's the self-talk or what do you do? And just $250,000 is a lot of money.
Well, a lot of it's how you respond or react to things, and how you recover, what your mindset is. I never really look at it as a failure. It's more of what did I learn along the way type of thing. So for me, it's always I learned something from that. What's bad is if you keep repeating those, right? So obviously, you don't want to keep doing that. But I think a lot of it is, I don't care if you lose $100 on something. Hopefully you learn from some of those mistakes, and they can happen to a lot of us. We do a lot of things dramatically different today, just from the bad things that happen in the business. Whether it was a bad actor, a bad counterparty. Today we run a lot tighter ship from having a bad counterparty 10 years ago or whatever that was. You know what I mean? So those types of events, that's what's helping you to tighten up your systems and processes and compliance and things like that. Today, when we're vetting investments, a lot of times or partners, I'll use like a service like Prescient. Prescient will do, pretty in-depth background checks on individuals and companies, and they have a couple levels of service, and they're affordable and a quick turnaround. There's no reason to stick your neck out. Now, could you still lose money from the market or this or that? Yes. So you need to, invest wisely. And like you said, invest in what diversify into a couple areas. I invest in, here's an example. I invest in some commercial notes. They're completely counter-cyclical to what PPR does, right? And it's like a merchant cash advance type thing. And those assets are booming in an up market. PPR booms in a down market, right? So people might say, hey, that asset class is risky. And I'm like, yeah. And so is the other one. And I'm not that smart. I can't tell you when the next, what day the next recession hits, right?
Right.
But I can tell you I'm making money in all markets, right? So I think I've grown past some of that. I don't worry about, what's the next election going to do, or what's this going to do, or what's this new tax law going to do, or what are they going to do if they regulate this or that. I kind of more or less respond to things. I don't worry about what might happen. Now, I'm not foolish about it. It's not like I don't pay attention at all. I don't want you to think that, but I don't let that be the driver. It's more about how I respond to things than to what those things are,
Yeah, that's excellent. Very, 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 success minded. And I love that outlook. So many people are driven by fear, and that just slows them down and makes.
Yeah, they get paralyzed. They don't want to do anything. They just, and believe it or not doing anything is a decision, So
Yeah, I agree. And, that is the difference between someone like yourself and where Kevin and I are trying to be, and someone who looks at those people and thinks, how can they get there? Like, how can people get to that level? I think that's a big difference.
Or they're afraid of what people would think, or,
that's a big one.
Like, I'm kind of sticking my neck out there saying, hey, I lost money one time or here or a couple times or there, I could sit there and go, wow, I don't really want people to know that. They'll think less of me. Was some of the things in my control, were some of the things out of my control? And what could I do differently? Well, I would have never learned what I could do differently if I never did it.
Exactly.
Like if I just sat there and just said, I hope is my strategy. I hope something happens. I hope I end up with a good 401k when I go to retire. But, I watched my father do that. And, I watched him lose several $100,000 in his 401k right after he retired. And he had to go back to work at age 70. And I don't want that to happen to me, so I'm not going to, live at the whims of someone else. I'm going to take control of my investments and take control of my, outcome. And then it's on me, right? I'd rather be on me than someone else. Right?
Yeah, exactly.
Oh man. Yeah. That's awesome stuff.
You mentioned a lot of good nuggets there. Sorry, Adam. I just wanted to further clarify when you were talking about how PPR makes money on the downturn and the commercial notes make money the opposite end. Can you expand on that just a little bit for our listeners who don't know?
Well, yeah, the commercial notes I'm talking about are small business loans to small businesses that are backed by receivables, right? So they're really they're a form of commercial notes. I do it, similar fund structure where it's all over the country, multiple different kinds of companies, and there isn't a ton of collateral. It's not like it's against the property, right? It's really against, inventory, right? So you could say, hey, well, the inventory disappeared. Did you get paid? But it's like anything, there's a default rate, just like there is with, it could be like credit card debt, or, look at Lending Club. You can get in the note business with $25 by taking a piece of a loan in a Lending Club or a Prosper.com. So some people say, well, does it take a lot of money to get in the note business? No, it's $20. It's a case of, $25 is a case of beer, maybe, right? So it's not that much money. So it's really, how do you look at that? When I look at PPR, the bulk of our company was built with other people's capital, right? So I'm not saying we never had any skin in the game. We do, but the majority of the company was built without our capital, right? So it's not a case where I needed money to build PPR or anything. No, I just needed someone's money, but it didn't necessarily have to be, all mine or all my partners, right?
Sure.
Dave, you wrote a book, Real Estate Investing Notes. Are you showing us? Yes.
Backwards, probably. But
excellent.
Who cares?
Tell us about that. What was the inspiration for the book?
Well, a little bit of it was, working with Bigger Pockets. I, was fortunate enough to, be a member there early on, and, was a writer there, wrote a lot of articles, several hundred articles actually. And, was asked to be on a podcast. Today I'm pretty good friends with all the folks over there, Josh and Josh Dworkin, and, all their, higher level folks. And, I was just lucky. I was kind of, part of it was in the right place at the right time. They must have liked what I wrote about, and they asked me to write a book on note investing, and sort of it, I kind of told my story from really, I'm a real estate investor first and will always be. I like the tax advantages and things like that, but there's things we can do to be more efficient with our capital and more efficient with our properties, our investments, and our strategies that, we can make life easier for ourselves. We don't have to own a million properties. We don't have to have a lot of headaches if we don't want to. And over time, I started to look for things that were easier to manage, whether that was, multifamily with on-site maintenance and management, or, I invest in everything from ATM machines to life settlements, so I invest in a lot of different things. And I think just, a lot of the strategy, especially today, is based on timelines. I have short-term, mid-term, long-term things. I have liquid things. I have illiquid things. I have things that cash flow. I have things that appreciate. I have a mix of a lot of different things that I like. But they all tend to have their roots in something that I'm familiar with, right? So.
Excellent.
Fantastic. So, Dave, you also host a real estate summit. What was the inspiration behind that?
Well, actually, I have a friend from Bigger Pockets, Jay Martin, who runs one in the San Francisco Bay Area. And I don't know what made me go out there. He asked me when he first did it, he goes, hey, will you come out here and talk about notes? And I was like, who is this guy at first? But I did it. And then, the thing took off, and it was a unique event because there was really no gurus or selling anything at the back of the room type thing. And, I went out there, and he was doing it for charity for an orphanage in Vietnam. And I, kind of took that inspiration back to Philadelphia and said, I'm going to do this. Well, first I asked him, would he do it on the East Coast? He said, no, it's too much work. So that was part of the inspiration. And then it was a combination. I run that high net worth group. Basically, that group works like a Yelp. It's like an invite only for high net worth folks. And we share resources, right? We share advisors. We share alternative investment strategies. And what I did was I was like, well, you know what? Maybe I'll bring that concept to the masses at this summit, and I'll, come in and kind of cover a lot of these same ideas that we do in the high net worth group. Nothing would make me happier than to take folks who were like not accredited and help them, show them the way to become accredited.
Right.
Because, I was a very, I didn't have a lot of opportunity as a young person. I was raised by a single mom with 6 kids, so we were, we grew up on assistance and things like that. And today, obviously, I do pretty well. So it was kind of like, I kind of know what that takes to how did I come from, how do you go from assistance to being a high net worth, individual? And it does take some effort and some things along the way. And if I can guide someone else or show someone else some ways, and a lot of it is network, it's not always just education. A lot of people think, well, if I go here, sure, you can. I'm not saying you don't buy a network at Stanford. I'm not trying to, I'm not a fool, but at the same time, it's more than that. I didn't go to a fancy school. I went to a state college. I didn't have a super high level degree. I only have a bachelor's degree, but yet I've done pretty well. So I think there's more than one road that people can take and do very well. And I have a couple of friends that just went to high school, and I have one buddy who didn't even finish high school who is a multi-millionaire. So I don't know that always indicates outcome. I think there's other drivers sometimes.
Right.
Yeah. Oh, that's really cool. Yeah. I love some of the ideas you talked about there. Kevin and I both just really, we feel like what we've learned in the last few years, it's almost like we're looking at life through a different lens. And it's somewhat profound to us that everyone doesn't know this stuff. And I'm talking about things like that growth mindset, that abundance mindset, the way wealthy people think. And when you first find out about it, it's still fresh enough where I feel this way a lot. Like, is this real? I mean, is this a thing? And then every time I talk to someone like yourself, I'm reminded it is. It's just a different way that most people don't know to look at things. So when you said bringing some of those concepts to folks who otherwise don't have access to it, I'd just love to hear that. It's fantastic.
Well, it's like an entrepreneur mindset too, or, I mean, think about 95% of the people trade time for money, right?
Right.
5% trade money for results.
Yeah.
So it's a different mindset.
It is totally different.
Huge
way.
shift.
Totally different mindset. So it's, what are you going to leverage in the next 6 to 12 months is another good, I was saying earlier, what's the one thing? It's what can you leverage in your life right now? Could you leverage technology? Could you leverage human capital? Could you leverage, there's a lot of things, education. Could you leverage, there's a lot of things that we could leverage in the next 6 to 12 months that could be one of the main things that really change things dramatically. I could leverage a JV partner. Literally working on the biggest deal of my life right now. So, there's a lot of things you could, but you got to be ready to receive it, right? It's kind of like opportunities can come past you, right? And they'll just keep on going. But if you're not ready to receive it, it's almost like a spiritual thing, right? Are you ready to receive it today?
It really is.
But if you're not ready, it's just going to float on by. So it's kind of working on yourself. I'm a big Jim Rohn follower, work harder on yourself than you do on your job type stuff, And
yeah, it's fantastic. Okay, one last question here. We'd love to know what your thoughts are on the market. It's pretty clear to most people that we're at the top of a cycle. We've been in this up cycle for longer than we normally see in cycles. What are your thoughts on that? How are you looking at that, and what might you be doing right now to sort of prepare for where we are?
It's funny you say that. There's, I have one good friend who, has an economics background, and he tries to time the market. And then I have another friend who doesn't time the market. And I'm trying to figure out who I want to be going forward, right? Most of the time, up until now, I've been a guy that likes to think of himself as prepared all the time. And, for a while I was teaching a little bit about recession proofing your investing strategy. And really what the main gist of that talk is, you should be ready for a recession all the time. So if you set up your stuff, it becomes irrelevant, right? So
that's a good point.
I have things that aren't tied to the market. They're not tied to the real estate market, and they're not tied to the stock market. So how many people have those investments? I have investments that aren't tied to my current business. It's like, do you buy stock in the company where you work or whatever? You got to think about there's plenty of businesses that take off in recessions, right? So I think it's some of those, right? Like look at PPR. PPR, people say to me, well, what's PPR going to do in a recession? I'm like, are you kidding? You realize what we buy, right? Like, we buy distressed assets. If there's a recession, the biggest driver for our organization would be jobs, right? So if the economy and jobs tank, why do you think back in 08, 09, we were having a field day.
Right.
Assets became really cheap, really cheap, and abundant. Like I look back I wish I had some of the assets up in New York in the 5 boroughs and in Southern California. I'm like, how many assets we blew out the door that we should have held,
Yeah.
But, you can't kick yourself too bad on some of that stuff. But you get what I mean? Like, so in that regard, it's, I don't want to say bring it on, but it's not really the case. I don't really want to sound like, I want to profit from a down economy or anything like that. But there are definitely certain industries that do well in certain types of up market or down market. There's definitely some industries that benefit, in a down market or are recession proof. Like I have a good friend who just opened a business that is insurance related and it's tied to catastrophes and things and has nothing to do with the market. It has to do with the next hurricane or whatever. So it has, there's businesses out there that are definitely recession proof that people could think about for sure.
Yeah.
And then it's also about reserves, access to cash, maximizing your cash flows, maybe fixing and refi some of your rates. Basically, you kind of, read the writing on the wall. Like you said, it will be a year from now, 2 years from now. I'm not that smart. I don't know that I need to be that smart. I can just basically be prepared and always have access to cash and always have, the best cash flow and always have the best rates. Like one of my recent strategies where, deals are hard to find sometimes in an up market like now. Yeah. So one of my strategies, this is going to sound a little bizarre, but me and my family, some of my family members are paying each other's mortgages off on their investment properties. And basically we're charging each other like 7% interest only. And we're just doing it for each other. And we're getting rid of our Wells Fargo loans and things like that. We're just paying each other. And then the extra cash flow we're making, because we have interest only payments, with the extra cash flow, we're shoving it into insurance contracts. And then the insurance will pay our properties off if anything happens to us, right? So there's strategies out there that you can employ. And then I can build up the cash value inside the policy. And now it's real safe in there. It gets a little bit of a yield. No one can get at it. They can't sue me, or if I go bankrupt, they can't touch that money. Now, if I build up the cash inside the policy, I can borrow it out and pay a house off anytime I want. Right. But what's the advantage? And the answer is there's not much advantage, because if I have $3 million in property and $5 million in insurance, who cares when I pay them off? Right. Like, it's silly. So it's the family banking concept. That's what the Rockefellers did. That's what the Vanderbilts didn't do. Right. So either Vanderbilts are broke or the Rockefellers, because the Rockefellers basically incorporated like a family banking, infinite banking type concepts where you can, why think about your family, how everybody has a mortgage and they're all paying Wells Fargo. I'm just using them as an example, but not to pick on Wells. But we're all paying a regular bank when we could all be paying each other's loans, right? Like, we all have money in our retirement accounts and we all have mortgages. Like, hey, did we ever think that we could be each other's bank and, have, I'm not saying, whether you're family, financial family or financial friends, it works the same way. But, those types of simple concepts are, I'm having trouble finding a deal. Well, you know what? Maybe I'll pay off one of my rentals and you pay off one of mine. I'll pay off one of yours. And, I just did. I literally did 4 mortgages today for a family thing. Yeah.
That is something I've never heard of and I never would have thought about. So that's really interesting that you bring that up. But ultimately,
like if you can't find a deal, why not get rid of some debt? Not that I love to pay down debt. I'm usually in accumulation mode. But I'm approaching a recession if I get rid of some traditional mortgages and can up my cash flow. If I convert from a P&I payment at a regular bank and go to interest only for 10 years to a relative, and they go interest only for 10 years to me, and I don't care what the rate is, we can charge each other whatever we want. And then I can back it, I can, bury some of my extra cash flow into bury it into policies and things like that. And then it's in a safer bucket. And then no one can touch it. It grows inside the policy. If I need to get my hands on it, I borrow it. It's a tax-free. So it's just a different way of thinking about some of the stuff.
That's an example of
like that.
Of so staying creative. Ready.
Very creative. Really cool.
Now, the last question we want to ask you, we wouldn't be Tech Guys Who Invest if we didn't ask a question about tech.
Oh boy.
So in your daily life as a CEO, what is a piece of tech that really helps you out?
Well, it's funny you said it's my IT guy, it's my department. Get your butt down here and fix this. No, I mean, it's funny. We use a ton of it, right? So we're a data company basically. So our data becomes the DNA of our business, right? There's nothing more valuable to us than our data, right? Because we have data on assets from so many years now. We can scrub a pool. We can tell exactly what it is that somebody's trying to tell us. We can tell you exactly what it's worth. We can kind of predict pretty confidently what that's going to, generate over time. So that's a pretty powerful tool that way. We actually have like an automated value chain model that's internal, that's custom to us, right? It's proprietary, right? So that's probably the big thing. I know over the years, I remember when we first started in the business, you'll love this piece of technology. I was using a Magic Jack on a laptop, and we had no office. I was operating like on the hood of my car, and that was my 800 number was in the Magic Jack. People in the car were like, what's a Magic Jack? But and I don't know. I think, I remember when there was a time when there wasn't much technology. I remember when the beeper came out as a real estate agent. I had a phone that was like a shoe. And I remember my first calculator. I was like in 4th grade, and I got this thing from, I think it was like Fidelity Bank. It was the Bomar Brain. It was the dumbest calculator you ever saw. All it could do is add, subtract, multiply, and divide. And I thought that was the thing. And then, of course, Texas Instruments came out with the TI-30 or whatever. And you laugh about that, but look where we are today, right?
Oh, yeah.
The capability just in my phone is this off the wall. You can hear my heart beating and stuff. How did it, when you look back to, I was thinking about technology I had when we were younger, but even the beeper, and most people are like, what the hell's a beeper? I can see the show notes now, but we were actually texting on the beeper. I remember like my wife would have a code because it was numbers, and it would be like, bring home, I go, press this if you want me to bring home bread or milk or whatever, whatever that was at the time, it was kind of like that. And you were like messaging each other with numbers. So really the beeper was the invention of the text, if you think about it.
Yeah, no, that's so funny. We did that too. I'm old enough to where we had beepers when we were like teenagers, and we would put little codes to our friends so we would know who it was, because sometimes you'd call from a payphone.
Right.
They didn't know the number.
Payphones? I mean, that's like a thing of the past,
Yeah, totally.
And
it's a payphone.
I know in real estate, the big game changer was the fax machine, probably. And they're kind of obsolete now, right? But the fact, back then, signed, sealed, and delivered meant something. We were literally driving around at 2 a.m. getting paper signed, or midnight, where a fax machine eliminated all that nonsense, right? That was a big deal as a real estate agent, was the fax machine. And then today, it's everything's scanned, obviously, but
DocuSign.
DocuSign is so different. Today, our investors, we have a portal. We have DocuSign integrated into it. We have Verify Investor, does third-party accreditation to a law firm. It's all automated, all inside one system. All the documents come back. It's just amazing. And then we can upload all the financial. I mean, when I look at what we do today and the way we syndicated years ago, we would print out 100 pages in triplicate, mail it to somebody, they'd mail a copy back. It was silly. Like, we were killing trees left and right. Today, it's just like a different world, right? So
wow.
It's come so far when you think about some of the stuff.
Yeah, that's awesome. Only on Tech Guys Who Invest will you hear this kind of conversation. It's awesome.
Is that what you want to be?
I love
it. There's so many inventions, though. I mean, you really think about the tech guys. Wow, we use so much technology now. I mean, just checking out properties, right? Just look at the drones and things. I mean, it's just, I don't know where to begin,
Yeah. And some of the apps that allow you to look up real property data as you're driving down the street and all that. It's amazing right
just getting the public records. I mean, just like MERS doing automated recordings, and it's just it's ripe for some more transformation too, in a lot of the lending, financial services, all these industries are going to see dramatic changes. I think it's coming.
Well, Dave, thanks so much. We've really enjoyed having you on the show. You've added tons of value. We're so appreciative for you to come on. Can you tell folks where they can find you?
Yeah, a couple places. Probably the easiest is, PPR Noteco, NOTECO.com. You could go /resources. We have, an ebook on there and some groups and things like that. We have a distressed mortgages group on LinkedIn. We're always on Bigger Pockets. We answer questions literally daily. So if you have a note question, you can reach out to us. We will answer you. So those types of places are probably some of the best.
Awesome. Thanks so much.
Yeah.
That's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.